Yes, absolutely. And in fact, I think there are some technical factors at the moment that look as though they're going to boost the markets over and above what the central banks are doing directly. Everyone, as you say, is very focused on the story that all this stimulus is going to create inflation. And instead, when you can see very clearly in markets, it's creating asset price inflation instead, with all this worry about bubbles and with a massive gap between the underlying fundamentals and then markets doing ever better and ignoring those fundamentals.
Can I just take you to the incident of GameStop over the last couple of weeks, and not to talk about the stock specifically, but more what that episode has told us about financial markets. It seems as though these days flows and positioning are a bigger driver of markets than actual fundamentals. Do you agree?
Yes, absolutely. And indeed, this is a theme we focused on for a while. How can I put it? Value-driven investors are being forced out of business almost. And indeed, what we've seen for an extent of several years now is traditional patterns of sort of mean reversion. You buy when it's cheap, you sell when it's expensive. Those are kind of going out of the window and being replaced by momentum and herding, again, driven ultimately by the quantity of money being pumped into the system, ultimately by the central banks, and driving everything upwards. And that creates this very difficult environment for any type of investor. It also changes, I think, the way that normally you would focus on, is the consensus overly long? Is the consensus overly short? How are active investors positioned? And instead for us, for a while, it's all been about measuring the quantity of money coming in, looking at fund flows, looking at reach for yield, looking at central bank purchases and balance sheets as a measure of this.
On a related note, looking through your latest research note, one chart jumped out to me, and that was the chart on Bitcoin that you included, showing this correlation between China, total social financing and credit creation, and the meteoric rise that we've seen in Bitcoin. Taking into account all of the factors that you just mentioned when it comes to the market rally, what do you read into this, and what's been your take on the rise in Bitcoin?
So it gets harder when we focus. It's all about the total amount of money coming in, but at the same time, when it gets concentrated in a small space like GameStop or like Bitcoin, you can have this outsized price impact. I do think I've noticed that correlation between China total social financing and Bitcoin for a while. I do suspect that it indicates that more of the money coming into Bitcoin has come from China than is widely recognized. That said, Bitcoin is its own kind of separate story. And recently I've been concerned about the very large proportion that seems to be coming not from standard currencies, but from a stable coin called Tether. But without wanting to go into too much detail on Bitcoin, again, for us, this is all part of a big picture story where it's about this money flow coming in. And China total social financing has been a large part of the private sector flow in recent years, with less borrowing in Western economies since 2008. But the biggest and most obvious driver has been the central banks and the almost minor changes in central bank balance sheets, which again are having outsized effects. And actually for me, the main point in this note is that almost hidden in plain sight, over the next 3 months or so, you're about to release another $1.5 trillion of liquidity from the Fed's balance sheet, but not because of the QE that it's doing, because of these rather technical factors to do with the Treasury General account. And this is a story which I think the money market investors are all over, and yet for me, it's an additional boost to asset prices more broadly, and I just don't see people focusing on it.